Lori here. So today's Thursday business tip is going to be about taxes. So I'm actually going to do the next few tips on taxes. So it's almost the end of the year. As a matter of fact, it is very, very close to the end of the year. And one thing that you really need to keep in mind is you need to get all of your stuff together for your taxes. And I really want to kind of just give you an idea of what you need to do and what you need to think about. So the majority of entrepreneurs are going to be sole proprietors. Even if your business is an LLC, and LLC means limited liability company, and all that really means is that you are protected from someone going after your personal assets. That's all it really means. However, if you have applied for an LLC with your state and you have gotten your federal ID number, and you do need both, you really need them if you are going in the route of business where you are trying to make a profit from a business. You really need to go ahead and get both. You will see that the IRS and the state both consider an LLC single member to be a sole proprietor. So all that means is that you're one person in business. In order to be really seen as an LLC, a true LLC, it has to be multiple members. So there would have to be multiple people in the company. So the state and the IRS understands that you want to have that designation to protect your assets, but they're not going to give you that designation for tax purposes. So for tax purposes, you really are a sole proprietor. So let's talk about what that means. That means that you have to put your business income expenses on your personal taxes. So where that goes is it goes on your Schedule C. And so you need to make sure that you have all of your revenue and expenses together to put on that Schedule C. So I just really wanted you to understand that when you are a sole proprietor, that it is going to go on your personal taxes. So even if you have multiple members and you have an LLC and you have, so if you're an LLC and you want your taxes to be filed outside of your personal taxes, you have to apply for an S corporation. So there's a tax form that you use and you apply for that. And I'm going to tell you, all that does is it requires you to file another tax return, and then that still flows through to your personal taxes. So no matter how your business is structured, it is still going to flow through to your personal taxes. So LLP, which is limited liability partnership, so if you and your spouse are in something or you're in something with friends, LLCs, S corporations, all of these types of entities, these are legal entity names, they will be considered a pass-through entity. So what that means is that all of the income expenses passes through to your tax return. So it's really not difficult. It just means, okay, you might have to fill out another tax return, but you're going to get a statement that has to go on your tax return. So really, if you're just starting out, it's best just to get an LLC and file as a sole proprietor on your Schedule C. It's going to be easier, it's going to be less expensive, and really you don't need all the other if you're just one person. Now, if there are multiple people, then you really need to consider doing either a partnership or an LLC where you actually file as an LLC, but remember that income is going to still come to you. So when you file a separate return, because you are an LLC, an LLP, or an S corporation, what happens is the net effect. So the income or loss comes to your return. So that's the difference. Everything, if you are a sole proprietor, is recorded on your return. Your income, your expenses individually, and then of course your end result, which is your loss or profit. All of that is recorded on your income tax. If you are filing it as a separate return, then just the net effect is what goes on your return. So I don't want to confuse you, but just kind of want you to understand what that means. So I'm going to kind of do this over a series of a couple tips, and I really kind of want to go through what's income, what's expense, how do you have to have your receipts, and I want to make sure that you really understand what you need, and you need to be careful. The Schedule C, which is what businesses are recorded under the tax, is the most audited form for the IRS. Okay, so that means that you need to be really careful when you're filling out your form. There are certain things on there that trigger audits, and so you want to be aware of those so that you can avoid that. I can tell you that being a CPA for many years, I have seen it over and over and over again. People have a tendency to kind of mix personal and business expense. Don't do it. Just don't do it. Because if you get on the IRS's radar, let's say, then they may come back and audit you again and again and again and again. So as long as you are very consistent with how you are doing things, and there are certain things that we're going to talk about to make sure that you have everything lined up. The IRS is going to be looking for excessive expenses. They're going to be looking for people to use their home as a business. And you can do that, but there are really specific rules about how you do that and what is considered something that you can use. So you have to be super careful. They're going to be looking for things like you're writing off a car and saying it's for business use. Really big expenses. They're going to be looking for, okay, in a 5-year period, did you lose money more than 3 years? Okay, so when you first start out business, they kind of, the best rule of thumb in business is that you should be making a profit after 3 years. If you're not making a profit after 3 years, then something isn't right in your business. But a lot of businesses are expected to lose money in the first 3 years. Now, that doesn't mean that's what's going to happen with you, but just keep in mind that you don't want to have a loss like every year consistently, because the IRS is going to say, is that a way to create a tax deduction? So they're going to go and they're going to look at that. And there are some big tax law changes that are coming down the pipe. And so you just need to be very careful, because if these new tax laws go into effect, a lot of the ways that we do small business, which you are considered to be a micro business if you make less than $350,000 a year, you're considered to be a micro business. So you just want to be really careful in how you record things, and make sure that you understand what your designation is, what your type of business is. Okay, so this is just kind of a general, this is what we're going to be talking about in the next few tips. And so in the next tip, I will be talking to you about what is income, what do you put in income, and just some kind of the things that I see that people get in trouble with. Okay, so I will see you in the next tip. And just remember that I have a business group, and I teach them how to open their business, how to make their business successful, and we are going to be going through the Schedule C very closely. I'm actually going to be doing a training and, you know, showing them some little tips on how they need to do it, because even if you have a preparer, a CPA, or a firm that prepares your return, you still need to understand what goes on it, because you know what, they're not perfect. They can make mistakes, and guess what? Ultimately, it is your responsibility to know what is on your return and to be responsible for it. Unfortunately, ignorance is not a defense when it comes to income taxes. So make sure you understand. Yeah, you don't have to be a CPA. You just need to understand really what's accepted, what's not. Okay, so if you're interested in those, if you're interested in guidance, we have a fantastic group. Love my group. And we have Zoom calls every week where they can ask me questions and I can show them things. And then, of course, I have training every month. There's quite a bit recorded so far. But you can find the links down below, and I will see you in the next video. Thanks for watching. Bye-bye.